Something big is happening in the market, but not in the way you think. End of quarter rebalancing took center stage today as stocks snapped their 3-day losing streak. But was today's rally just another bull trap? Today, we ask and answer that question. Is Wall Street baiting retail in hook, line, and sinker, or could this be the start of the small cap breakout we've all been waiting for? Today, we're going to discuss that and sentiment, what the big boys are buying, as well as liquidity. Liquidity is the lifeblood of the market, and when it is abundant, stocks tend to soar. So as the S&P 500 makes another new all-time closing high, let's talk about what comes next. So sit back, relax, and let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. Guys, a very green day here today in the S&P 500. Okay, excluding Nvidia, Broadcom, this section here in technology and the bigger SaaS names, everything else was green. I mean, you even look at it like right here, semiconductors, super green. So if you hold semiconductors on an equal weight basis, your portfolio is going to do really well, right? You look at this part of software application, you hold software on an equal weight basis, your portfolio is going to do really well. You hold Apple at all, you're going to have a great day today in your portfolio, but green everywhere else. I mean, look at utilities, real estate, industrials, healthcare. That's a very green day. Same too here with consumer defensives. And guys, breaking down the sectors, GDX up 3.72%, regional banks, metals, mining, utilities, real estate, home construction, right? But then we go all the way down here, the SPY up 0.84%. Every sector beat the SPY. I mean, this looks at the bottom of the list, energy up 0.93%, nearly 1% gain for the day. The only sectors that didn't beat the SPY, XLC, technology, still a gain by the way. Semiconductors flat despite Nvidia down 2 to 3% for the day. And then software, okay, bit of a dumpster fire, but I think if you have an equal weight approach to your software names, you're going to do really well today. So just broad-based buying across the board, and there was one single reason for it, guys. It had to do with end of quarter rebalancing. This is exactly what end of quarter rebalancing looks like. When we've had a quarter as strong as we have, collateral reinvestment flows into stocks, particularly underperforming assets, underallocated assets. And what funds will normally do is trim the gains of the big guys. So we see stuff like infrastructure technology, Microsoft, Nvidia, right? They'll trim those gains and just put it into other names that haven't been performing well, that might perform well over the next quarter. And that's why you see sectors perform on a quarter-over-quarter basis rather than a month-over-month basis. And that's because it has to do with these big funds and their end of quarter rebalancing, both buying and selling. So that's exactly what we saw. We saw the best performing sectors of this year get sold off today and go into pretty much everything else, including small size, mid caps, small caps. And I think what we also saw was funds buying / hedging ahead of the PCE data on Friday because the market's going to be closed. And all of this led to a perfect storm, which saw a real heavy late day rally in the S&P 500. But let's hop on the charts really quick. Now let's actually have a look at the indexes. Now the best performing indices, guys, here, IWM, S&P 600 mid caps, right? They were the best performers, high beta, small size, medium size, in comparison to the S&P 500, which was still very green, up 0.86%. The Nasdaq didn't perform the best, up 0.39%, but the RSP, huge outperformance here, 1.6%, doubling the S&P 500. Crazy day, and actually flat in after hours. Now futures are down a little bit, but that's actually normally what happens right after the American close. Asia opens, and normally futures do actually trade lower a little bit, especially after very green days, and then they do lift once Europe opens. But let's actually have a look at the S&P 600 because we saw some very key things. Now this is the weekly chart. We can see an all-time weekly closing high. We've never been high on a weekly basis, but the weekly chart is not done. The exact same thing here on the daily chart. All-time high close for the S&P 500, 52.48, nearly 52.50. Now looking at the actual candle, we have a long wick at the bottom, no wick at the top. Very bullish candle, engulfing, 1, 2, 3 days worth of trade, especially considering that we gapped up to this level and then buyers came in a very strong way at the lows of the day to close at the highs. Now let's actually just hop on the 5-minute chart and I'll show you what today's trade looked like. So we actually gapped up and then traded lower in very early morning trade, and we traded this range, but we actually did set up for a rally because we made a low, higher high, higher low, higher high, and then another higher low. Then when we broke this high, we rallied. Then when we broke this high, we just capitulated all the way to new all-time highs and closed at new all-time highs. And this right here, this turn happened, okay, because funds were rebalancing their portfolios for the quarter. Funds were hedging ahead of PCE, and then algos and zero DTE traders saw the flows, and then they helped push the index absolutely high. And when all three of these traders are aligned, we have like retail, dumb money, smart money, all moving in one direction. We just get a huge move off the lows, especially if you look down the ranks and stuff like RSP, mid caps, small caps. It was a broad-based buying and everybody was on the right side of the trade, and that's why we got this massive move in the late day of trade. Now, in terms of levels, what can we look at? Well, we're sitting at 5250 right now. I would just look at 5300 and I would look at the high of Monday right here at 5262. Those are the levels I would look at. In terms of downside, I would still keep the exact same levels we've been looking at all week. And this is actually what I said would happen, guys. I said here in my weekend video when we closed out here, I said what's going to happen is we're going to probably trade lower towards the 5180 zone. I did say the 5180 zone is probably where we would find support. The market front run it a bit. It happens. No one can ever call it exactly the way it is, especially right here. There's no way no one's going to know we're going to start buying there. Funds just start buying, and then when you see the flows intraday, that's when you want to get in, at least as a trader. And I said if we broke 5180, we would look to 5137. So my thesis was right. The levels were just wrong. It happens. No one's ever going to get the right levels all the time. But that being said, we are still 100% fully invested in this rally, and yeah, it's been absolutely fantastic. An all-time daily closing high. We're going to look to 5300, this level right here. There's actually not much to say apart from just like hold equities that you have right now. You know, for those of you that bought at the start of the year, for those of you that bought at the October lows, or pretty much any time during the year, January, February, you just want to hold equities. And when you get this type of volatility, you just want to sit through it, okay? Because in a market, in a momentum market, generally speaking, you know, red days probably only last a couple of days, a week at most, and then we do see a movement back in the momentum trade, especially to the upside. You know, upside rallies, bull market rallies last literally years and decades. Now, I want to show you something very interesting. This is the S&P 600. These are the key levels I'm looking at, right? Let's hop on the weekly chart. Some very interesting stuff. Let's actually just remove these drawings, right, guys? So I'm going to mark out the close of the S&P 600. Guys, this right here, the last time we had a close this high in the S&P 600 was here, okay? That was 14th March 2022. If we can see like follow through over the next couple of days, let's even say next couple of weeks, we're going to be closing above, you know, these pre-2022 levels, taking these highs. Then we can start looking at these highs right here, which is extremely close to new all-time highs in the S&P 600. The IWM is actually putting in even better levels right there because it closed at the highest high since this close right here, which is 10th of January 2022. So the IWM and small caps are really trying to break out of this range, and that's exactly what we're seeing, especially with this close. What we really want to see is follow through tomorrow. Now, don't worry what futures are doing. It doesn't matter. You want to look at what's happening in the actual American trade tomorrow. Now, tomorrow is the last day of trade for the week. So if we do pull back tomorrow, that would be completely like normal ahead of the weekend, especially with PCE data releasing. As long as we probably stay above, I would say, the 200 mark, probably the 202 mark, but ideally the 200 mark, we stay above that level. I think we're going to see continuation next week here in IWM, and it's a very similar situation for mid caps to the S&P 500. All-time weekly closing high here, and you know, we just want to look to the next level, which would be like 3150 in mid caps. Looking at the RSP, strong day, all-time highs, never been higher, even on a daily chart. The highest daily close ever, an all-time closing high. Extremely bullish. And in the weekend video, we said 163 was the level we wanted to buy. Again, the market didn't even get there. The thesis was right. We did trade lower. It's just that the RSP was super strong. End of quarter rebalancing has taken this market a lot higher, and I do think we could probably look at maybe the 170 level, 172 level here for the RSP. All in all, a very strong day, broad-based day, and yeah, end of quarter rebalancing. I think we might see more of the same tomorrow. It really depends, especially with PCE data and Good Friday. I have no idea what's going to happen tomorrow. It's sort of like a perfect storm of trading days, and funds rebalancing their portfolios. But we can't deny the fact that this was a very, very strong day, and it felt like a breath thrust in the smaller names. Like, this is a very strong rally. Same here with the IWM as well as mid caps. It felt like there was something underneath that move in terms of the strength and volume we saw, especially towards the end of the day. Now guys, looking at sentiment, the BOFA Bull Bear Indicator is now at 6.1. The Goldman Sachs Sentiment Indicator is now at 1.4. I showed you this stat earlier in the week, but we didn't have the Goldman Sachs Sentiment Indicator. Now positioning is still stretched, but it did tick down in a big way from the 2 handle to 1.4, and all of these indicators right now are telling us to hold equities simply because they are pulling back. Because we've made a ton of gains, we don't really want to disrupt the compounding abilities of our positions. We just want to hold through the volatility, but there hasn't really been much volatility. So I think a lot of this data points is pricing in like future earnings, rate cuts, a stronger economy, that sort of stuff. And that's why we're ticking back ever so slightly here in sentiment for both these indicators. Now let's talk about Good Friday. So this is just some stats here. Average returns before and after the Good Friday period. We could see that the Dow Jones, SPY, QQQs, and the RTY, normally 3 days before, 2 days before, we see pretty muted gains in trade, except for the Qs right here. They do perform pretty handily. Then 1 day before Good Friday, we see complete outperformance in almost every single sector. Then we have Good Friday right here. And then the day after, when we open again, that should be the Monday, I think, we see a pretty deep red day. So we normally rally in, sell the news, and then we rally again 2 days after. So just some stats for you guys to use if you are traders. And so maybe do expect a little bit of volatility after Good Friday. If we do get it, completely normal and would actually be healthy for the rally as a whole. Now let's actually talk about the rally. So guys, the current rally is stronger and broader than the average 100-day rally from a bottom. I actually found this very, very interesting. So these are all the bull markets here, and it's percentage of up volume days above 80%, and then the actual returns. And if we actually like draw a line right up here, the only stocks that have really beaten our current rally in return in the first 100 days is like 7 individual times. Other than that, this rally has outperformed almost every other rally in history. And it just goes to show the strength we've seen since the October lows. At the same time, we're also seeing strong up volume. Number of times we've had 80% up volume days, more than 10. Average is actually 10. So we're seeing a strong rally on good volume, great returns. And what does that mean? It probably means more of the same. Strength brings strength, momentum brings momentum. Now, let's switch gears, talk about the economy. Let's actually look at consumer confidence. Now we got the latest Conference Board Consumer Confidence Index, and it pretty much stayed the same. Nothing has changed. Now we're not super euphoric here in consumer confidence, and we're not down in the dumps like we were in 2020. I would say that consumer confidence is ticking down from where it was in 2021. However, we're still pretty average. Consumer confidence isn't exuberant, it isn't pessimistic, it's just middle of the road. And in light of this, what are retail doing with their money? What are smart money doing with their money? Now we can see here that last week we had total inflows into equities led by corporations. What is this pretty much? This right here is buybacks. So the biggest buyers of stocks last week were corporations, were buybacks. At the same time, retail actually had outflows. Institutions had outflows for the week, inflows for the last 4 weeks, and then hedge funds. I mean, when are hedge funds ever not buying this market? I mean, at market lows they're selling, at market highs they're selling. I swear hedge funds are just constantly selling this market. But what were corporates buying and what were institutions buying in that period? Now we could see here that the biggest inflows was tech, comm services, and industrials. So considering the fact that we had corporations buy the most stock, it just goes to show that it probably was in the tech sector, comm services sector, and industrial sector, because these sectors have the most buybacks of pretty much every other sector. And I do think that the next earnings season is about 20 days away, about 15 trading days away. And you know, the blackout period is coming very, very soon. So there's going to be a huge ramp up in buybacks. I think that's why PayPal is doing really, really well. I think think a lot of the price action we're seeing is buybacks in PayPal. So just some very interesting data there for you guys. Now, a lot of the recent flows can be explained by rising cyclical growth and favorable seasonality, suggesting that the portion driven by risk appetite has risen only slightly, but still above average. Now, this is risk appetite in flows after adjusting for seasonality and cyclical growth. This is where we are right now. We've come out of this like trough right here. This is where we are. We're pretty much at the 0% line. And normally when we've come out of a trough, hit the 0% line, we normally see massive rallies in risk appetite. And that's normally because retail is chasing the rally after smart money bought the dip. And this time it's no different. I do think that we're going to continue to see an appetite for risk, especially as we move closer to rate cuts, especially as the government keeps spending money, especially as bonds get issued in near record amounts. Equity risk is a hedge against debasement, and that's why I do think risk appetite will increase throughout 2024, 25, 26. That being said, the data is here, and after adjusting for seasonality and cyclical growth, risk appetite is above average, but not quite all there in a market that's come up 30% in the last 3 months. Now, looking at liquidity, this is where it can get pretty crazy. This is United States liquidity conditions and the same for the Eurozone. And we can see that we have come down significantly, but we are starting to go from this bid section right here into turbo bid. I don't know why they named it like this. The same is true right here for the Eurozone. And this is going to be a real tailwind for equities if this does continue to go up, and especially as rate cuts come into the market, as we do start to see balance sheet runoff tapering. That's just going to produce more liquidity into the market, and that's generally good for assets. Now let's talk more about the economy. This is manufacturing output PMIs. They edged up in all major developed markets in March. As you can see, PMIs have troughed and are moving upward, and I do have the stats right here for you guys. So what we're going to look at is the average right here, and pretty much the S&P 500 rebounds strongly after PMIs trough. So right here, this line, PMIs trough, this is what we can expect. This red line is our current rally, and on average we are above the average, right? But on average we normally do expect a very strong rally with very linear returns, and that's exactly what we've seen in the market lately. Yeah, we have had pullbacks here at the start of January. We have had weekly intra-week pullbacks, but all we're seeing in the market is dip buying, and that's actually normally what happens after PMIs make a bottom. Looking at other parts of the economy, stuff like commodities, interest rate cuts in a non-recessionary environment typically lead to higher commodity prices, and not just commodity prices, asset prices as a whole. If we get rate cuts and there's no recession, and then we get the reflation trade, and pretty much the prices of all assets move higher in tandem to mark up for inflation. This was part of the reason why that 2020-2021 rally was so crazy, and nothing is more affected by reflation than commodities. And we can see after we get 100 basis points worth of cuts, we normally see immediate rallies here in copper, metals, gold, Brent, aluminium, and we could see rallies upward of 6% in different types of metals. We even see rallies in Brent, and this is what normally happens. Commodities are a hedge against inflation. Now let's talk about gamma. Now we are going to look at a whole bunch of charts. It's sector charts against the S&P 500, and we look at these charts just to gauge what sectors are performing the best, where we want to be, where there might be rebounds. And we generally look at these type of charts once a week, maybe once a fortnight, or bi-weekly in America. I believe that's what you guys call it. But just a bit of context, if the chart is moving up, it means the index is outperforming the SPY. If the chart is moving down, it means the SPY is outperforming the index. It doesn't mean that these sectors are taking on losses. It just means that maybe the SPY might have returned 10%, the sector might return 8%, or vice versa. Let's have a look at this right here, technology. You can see the charts moving from the bottom left to the top right. That means tech is outperforming the SPY. However, we could see that from about December, late November, it's moving sideways. In other words, the S&P 500 and the technology sector have roughly gained about the same in this time period. In fact, if you take it from the highs here in February, the SPY has handily outperformed the technology sector. And this just goes to show the broadening of the market we've seen in the last 2 to 3 months. That being said, I do expect technology to continue to outperform. And if you do look at these charts, it's higher lows and higher highs on the way up, and this doesn't seem any different right now, probably until we actually go and break this level right here. Then we can maybe start to see some pure outperformance in the S&P 500, but until then, this is just the market broadening out away from technology into the rest of the market. Looking at XLC, a derivative of technology, very similar situation. We've seen outperformance in the S&P 500. However, in the longer term, the last year, communication services has outperformed the SPY. And again, higher highs and again, higher lows and higher highs. And you should expect that to continue, especially with a low here, higher low, higher high. You should expect another high to be made here in comm services. Nothing should change on this chart, especially with the composition of the sector. Meta, Google, Disney, Netflix, the biggest names in there, huge runners. They really do outperform the S&P 500 for the most part. Looking at discretionary now, this one is extremely volatile. We have this trend line right here that has been used as support right here, right here as well. It's actually broken below. Support is now turning into resistance, and discretionary really needs to go ahead and take this resistance line. Otherwise, it's probably going to see more outperformance in the S&P 500. Now, had you bought the 2023 lows right here, you would have outperformed the S&P 500 for the most part. But looking at from the July highs, yeah, the S&P 500 has completely outperformed the discretionary sector. And that's because stuff like Nike, Lululemon, Tesla just haven't been performing well, and they are big constituents in this sector. Looking at staples, not much to say. This chart is moving top left to bottom right, and pretty much this chart is telling you to hold risk on versus risk off assets. Looking at XLV, very much the same thing. I would say we're trying to find a bottom here in healthcare, but we're simply not. As you can see right here, we formed lows, equal lows I would say, and then we go form a lower low until we go ahead and break like key levels here in the XLV. That's when healthcare will probably start outperforming the SPY, and probably you want to hold the S&P 500 over healthcare in your portfolio unless you look at very specific healthcare names like Eli Lilly or Novo Nordisk. Utilities, very similar to staples. It's a risk on environment, and that's why the SPY is outperforming the utility sector. Looking at energy, we formed a massive bottom right here, and we're slowly on our way to retake the first key level, which is this high we made here at the start of 2024. All in all, the SPY has outperformed the energy sector in the last year, but energy is looking to make a comeback, as we probably will see higher inflation over the next couple of months with the Fed changing its goalpost and the reflation trade coming back into focus. Would love to see outperformance in energy. I do hold quite a lot of energy stocks. Looking at the XLF now, it's traded roughly in line with the S&P 500. It's outperformed since July, ever so slightly, but all in all, from the start of 2023 after the SVB crisis, financials have underperformed the S&P 500 for the most part. That being said, I am quite bullish on financials this year. I hold a lot of financials in my undervalued portfolio and do expect outperformance in financials over the next couple of months. That being said, the SPY has returned about 30% since November right here, and that means financials have outperformed the S&P 500 ever so slightly, probably returning 40% in that regard. So yeah, not a bad trade at all, especially if you got in at these levels. Financials trading at like 13 PE, 14 PE, not a bad trade, not a bad value trade at all. And I do think they will continue to outperform. Looking at materials, very similar to energy, with inflation ticking up, material sector is going to come into focus, and the material sector really needs to go and take these levels right here. It does that, and we could really see outperformance in materials, but it's all going to depend on inflation. It's all going to depend on how the recovery takes place, as well as PMI recovery in the global market. Looking at industrials now, industrials are exhibiting awesome strength. The industrial chart looks awesome, but against the S&P 500, it's underperformed the SPY. However, it has been outperforming here in 2024. As you can see, it's pretty much gone straight up, and it looks like it's pulling back ever so slightly, but that's just the way the market goes. It can't just continue to do this all the way up, but it really needs to go and retake this level right here. It does that, and we could see further outperformance in industrials. All in all, this was a great bottom to buy here, a double bottom, an equal low, a slightly higher low if you want to split hairs, and it's off to the races here for industrials. Now, looking at real estate, man, what a chart. You think with oncoming rate cuts and the inflation surge that this would really help real estate, but it simply has not helped the real estate sector at all. We keep breaking critical lows like these levels and these levels here in real estate. And I think as long as housing affordability remains where it is, as long as office remains the dumpster fire that it is, I think real estate is going to continue to underperform the SPY over the next couple of years. Even if we do get rate cuts that are incoming, I think some of the problems are deeply rooted in the heart of the economy economy here in real estate. You know, if you do want to get into real estate, I'd look at stuff like Vici, stuff like that. You know, maybe Realty Income Corp. The ticker is O, but yeah, I wouldn't go near the sector just yet. I was looking at it a while ago. It did look attractive at these levels right here, but you know, ever since this, it's not looking good against the S&P 500. And at the same time, you know, the S&P 500 hasn't really moved in the last week. And we're still seeing complete underperformance here in real estate. Not something you want to see. Now, out of all of those sectors, what do I think is going to perform the best? Well, number one, it's still a risk on environment, and I would definitely hold technology and comm services in your portfolio. I would stay away from risk off sectors, and I would stay in cyclicals. You know, the short-term trends are highest in value-orientated sectors, but not necessarily defensives. Look at stuff like financials, industrials, materials, energy. I think they're going to perform really well in the next quarter. That's not to say these others won't perform. I just think that right now the charts look best for energy, materials, industrials, and financials. So data in the week ahead, guys. So for the rest of the week, we got GDP data right here, PMI data, sentiment data, and then PCE data is actually coming out on Good Friday when the market is closed. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.